Hello, good evening, everyone. Okay, before I pass the floor to Pak Ling, our resident moderator, let me introduce our new addition to the research team. As you know, there's been some changes in personnel. First and foremost, let me introduce Chai Yi, our latest addition to the research team. Chai Yi, yep, there she is. And thereafter, we have Crystal. Yeah. Okay. These are our two new analysts that joined us not too long ago. All right. Okay. With that, let's get today's show on. And Pak Ling, go ahead.
Hello, hello everyone. Good evening. Welcome to our fourth quarter 2024 market outlook webinar. I wish everyone is good. Kenny will lead us to his market outlook on the strategy part. Myself will be presenting uh, the sector outlook and also Malaysian stock pick, while Chayu and Crystal will present US and Hong Kong stock picks. So, ladies and gentlemen, if you have any questions, please key into the comment section. If you like our Facebook webinar, please hit the like button, join our Rakuten Ranger community and the Research Hive Telegram group for more insights. In our Rakuten Ranger private group, you can webinars and also stock pick and even investment idea. In the Telegram, Rakuten Trade Telegram group, we have web updates on companies exclusive for Rakuten clients. We are also in a investing note. And without further ado, okay, let's pass it to Kenny. Over to you.
Okay. Thanks, Pak Ling, for the introduction. Okay. Let me start the show tonight. With some recap on the market. All right. As you know from the title, are we back to the Premier League? The local boss. All right. I mean, as we all know, I think overall sentiment has improved. All right. I think basically due to some prominent catalysts. I think the most is the what we are experiencing now, political stability. Okay, and then of course we have this hard repatriation of overseas funds by the GLCs, as has been mooted by our PM Dato Sri Anwar, I think earlier this year. And of course, the FDIs, we've seen a surge in FDIs of late, especially on the data centers and on the tech sector, broadly speaking, right? And of course, the ringgit uptrend. Now you see a lot of YouTubers, they were taken aback by the strength of our ringgit, which I'll tell you why later in the presentation. And of course, the inflows of foreign funds back into our stock market, right? I think having said this, right, the process has not been at all smooth, I think basically attributed to some vagaries on the Wall Street, especially, as we all know that at the moment, U.S. stocks has been trading at all-time high, historical high, so it is very difficult to justify more upside for the U.S. market, right? So what we're experiencing now is the way that the experts are translating, all right, their economic data, whether good or bad. So as we can see, in early August this year, the yen carry trade debacle, I think this has also spooked confidence globally, not only for Malaysia, right? At least now we have somewhat rebounded now. Having said that, we would say that externalities, would remain as our main concerns going forward, but certainly domestically we are doing very well, right? So we look at our performance of corporate Malaysia. I think 2023, okay. I think we ended last year on a rather flat note with earnings growth of 1.5%, which is deemed not too bad. I think when we started last year, it was a negative growth, if I'm not mistaken. Okay, so for this year, forecast has been relatively decent at about 15.4%. All right, I think there's been some tweak, especially for the I think the consumer sector that has brought the overall earnings growth down a bit, vis-a-vis our previous estimate of 16.1%. As for next year, we are expecting about a 9% earnings growth. Could be higher actually. All right, maybe higher actually, depending on the performance of our banks. All right, next please. Okay, before we dwell into Malaysia, let's have a peek at the US. All right. As I mentioned just now, I think Wall Street is still faced with numerous headwinds. All right. Of course, all eyes will be on the Federal Reserve. I think tomorrow, on the adjustments of interest rates. I think certainly a cut is in the offing, but just the quantum of the adjustments. All right. At the moment, it is swing between 25, 50 basis points. Many experts are expecting a 50 basis points cut for tomorrow, right? So after September, there will be another two more FOMC meeting in November and December, and many are expecting the Feds to do more adjustments during the FOMC meeting for November and December. So all in all, if this happens, we may see possibly between 75 to 100 basis point adjustments in interest rates. So if the adjustment is high, okay, let's say 50 to 100, right? We may see funds shifting to bonds, especially on Wall Street, okay, bringing the yield much lower. So at the expense of equities. So sit tight because if this happens, right, we are expecting some volatility on the equity market, especially now. Like I mentioned just now, most of the US stocks are trading at historical high valuations. I think later in this presentation, I'll show you, how high is the Dow Jones, Nasdaq, and S&P 500 is trading now on a PE basis. And of course, as I mentioned, the last quarter, the US debt ceiling risk remains unresolved, but it's still ticking higher. All right. Just to recap, I think this debt ceiling thing, has been suspended in June last year when the amount was 31.4 trillion USD. And now, surprise, surprise, it has jumped to about 35.4 trillion. Okay, in a matter of what? One year plus, it's jumped by more than 4 trillion. So come to year end, maybe we are looking at about 37, 38 trillion USD. So this is also another concerns that we are looking at. All right, next please. All right. This is another chart I love to show. Why Wall Street loves QE. I think QE, as you know, has been injecting a lot of liquidity in the market, especially the stock market. And hence you can see that this is the reason why US market has been trending on record highs, over the past year or so, right? Although the Fed has already initiated their quantitative tightening or QT, at around between 70 to 90 billion USD per month. I think the pace has been too slow, where there's still about 7.4 trillion circulating within the system. I think at the peak, right, from this QEs, total liquidity has surged by about 9 trillion USD. Now with this QT, quantitative tightening, I think this amount has been about 7.4 trillion, which is still a lot by comparison. Next, please. And who are the takers of this? I think we need some financing, right, for all these money printing processes by the Federal Reserves, right? I think on the foreign side, usually it will be the Japan, China, and also of course the Europe countries, right? That has been the main buyers of U.S. Treasuries. I think China has been a prominent seller over the past couple of years. I think at a peak they were the largest holders of U.S. Treasury to a tune of 1.4 trillion USD. But after selling down their holdings, it is hovering at around the 770 billion USD. I think looking at it, they have sold more than half of their holdings from the peak. While Japan, I think, is still around about 1.2 trillion USD they're holding. I think Japan also has been selling a bit, but that is just to defend their or to prop up their yen, which has been very weak over the past few months. If you notice, I think the yen has strengthened from 160 yen to 1 USD to now around 140. So this is due to some of the selling of the US bonds by the Japanese government. Next, please. Okay, moving to Hong Kong. I think Hong Kong is still stuck in a stop-start, mode. Although the performance of the Hang Seng Index has been rather steady, but there's no prominent or apparent catalyst to boost the Hong Kong market or the Chinese market, right? And also, there's been really an apparent lack of interest in Hong Kong stocks amongst the foreign funds. I will show you the table afterwards, to justify this argument as well. Why? I think because there's been a persistent weak economic data from China, that's further eroding market interest, especially on Hong Kong, right? I think the latest industrial production, retail sales, and also the fixed asset investments data for August all fell below expectations. All right, this has instigated, some of the experts, right, saying that China may be prompted to reduce their reserve requirement ratio by the People's Bank of China, okay, PBOC, the central bank, by around 50 basis points to spur economic activities. So currently the weighted average triple R stands at 7%, which leaves a lot of room for further cuts, and a back envelope estimation, right? A 25 basis point cut in the triple R is estimated to add around 70 billion USD into the financial system. Okay, so in addition to that, I think there's also a recent report, I think by Bloomberg, that China may be looking to reduce mortgage rate on more than 5 trillion USD of loans. Okay, this also, if this happens, this may also inject some confidence, hence interest on the Hong Kong market going forward. All right. But at the moment, right, despite Hong Kong stocks, we've been talking about this for the past year or so, trading at historically low PEs and remain dirt cheap, right? Still, it's not moving anywhere. I think, and why are these foreign funds shunning, the Hong Kong market? Next, please. Okay, just a quick one on the valuations of Wall Street versus the Hang Seng Index. As I mentioned just now, as you look at the valuations of Dow Jones, Nasdaq, and S&P 500 at the moment, you know, you look at the Nasdaq is almost double that of their historical average, right? So, and Dow Jones as well, you know, more than 20 times, and S&P 500 also as well. As you compare to Hang Seng Index, you know, poor Hang Seng Index, you know, it's traded at a single-digit PE, and still nobody is interested in picking up any Hong Kong stocks. You know, there must be a reason why, right? I'll tell you why afterwards. Next, please. Next, okay. Back to Malaysia. All right, if you look at the valuations of Malaysia, all right, I think at the moment we are still, not only Malaysia, all the markets within the ASEAN region, we are all still trading below our 5-year average PE. You know, you look at the estimated PE. Let's not look at the 2024. 2024 still below, but 2025 because we are towards the tail end of 2024. You know, we are certainly trading way below our historical 5-year PEs. You know, and you're looking at the performance year to date. You know, FPM KLCI. You know, I think for quite some time, I think we are now the number one performing market within the ASEAN region. You know, I think this should be applauded. I think we haven't seen this for so long. I think for over the past 10 years or so, right? Next, please. Okay, I mean, look at the funds flow. All right, I think usually when we talk about funds flow, you know, our focus is mainly on the net foreign inflow, right? But of late, right, I think we also noticed that the local institutions, you know, year to date net inflow of 1.5 or 1.15 billion ringgit, maybe slowly taking over the reign from the foreign funds. Okay, and we believe domestic fund flows to intensify over time going forward, and may take the lead to support or even prop up the local market, right? I think, okay, looking at the prevailing net foreign funds inflow, year to date, 3.5 billion, not too bad. We believe there is rebalancing of portfolio going on, all right, especially focusing on the ASEAN region, right? Especially now, there is an easing of interest rates environment over in the US and also in the EU region. All right. So I think with these funds, right, with the lower yields, they will be seeking for higher return, and of course, ASEAN good returns, cheap. You know, I think these are the two main ingredients for the foreign funds to look at. Next, please. All right. Okay. So why going back to the question, you know, why are the foreign funds still remain uninterested in Hong Kong? Here's why. You know, I think I've categorized, you know, this stock market into neutrals, bros, and not bros. I think this slides I've shown during the last quarter, but it's more prominent now. You can see that the performance of China and Hong Kong, right, is nothing near that of the bros. Look at Taiwan, Japan, and India, for example. You know, I think with this suspected boycott, okay, of foreign funds on both the China and Hong Kong markets, you know, inevitably it has placed, you know, our market, the neutrals within the ASEAN region, you know, in the limelight this year. You know, basically underpinned by solid valuations. You see all the year-to-date performance of the market within the ASEAN is all positive. I think things are really looking up for markets within the ASEAN region, especially Malaysia. Okay, next, please. Okay, this is rather sticky, okay, touching on the retail participation. I think retail participation has been, I'd say, a bit disappointing. All right. Despite the improved performance of the FBM small cap and ACE indices, year to date, but we have seen net outflows from the retail segment, totaling 4.7 billion ringgit. I think we suspect that this could be due to the influx of IPOs of late for this year. I think for the first half of this year, there were, I think, about 21 IPOs, raising approximately about 2.1 billion ringgit, right? I think not only this, all right, and also the high subscription rate would further support our observation that people are selling down the secondary market to move into the IPO market. As you look at, I mean, for instance, you look at Steelhawk, one of the latest IPO, it was oversubscribed by 277 times. All right, translating to 1 billion ringgit, chasing for 24.5 million shares, valued at 15 cents each. So imagine the amount of money being locked in, in this when you subscribe for the IPOs. So as a result, right, we are seeing retail participation to have shrunk from 26%, in January to currently about 18%. But hopefully, we hope to see this retail participation to improve going forward, which I will going to elaborate afterwards. Okay, next please. Okay, looking ahead, right? I mean, so are we Premier League material? Okay, this is the simple checklist that I have prepared. All right, and then first and foremost, I've mentioned now, political stability is of utmost importance, definitely. I think without political stability, right, no matter how well we are doing, I mean, whatever we are doing, right, there's no interest in our local market, or there won't be any foreign investments. I mean, just look at the period between 2018 to 2022. These are the period where we have had 4 different prime ministers, right? And you look at the performance of the KLCI. I think out of the 5 years, right, we have 4 years of negative performance. So hopefully this year, 2024, with the political climate more stabilized, I think that should translate into a more stabilized performance of the stock market as well, right? And of course, we cannot disregard the strengthening of the ringgit of our currency. I think during the weakest of our ringgit 480, I think that one basically is due to the over exuberance of those speculators. All right. I think what we are seeing now, just the normalization of the ringgit against the greenback or the USD, from 480 to currently 430. I think today it dips below 430 to about 426 or 427. I think the ringgit would continue to strengthen, especially after tomorrow's cut in interest rate, and also further cut in interest rate. I think that should also be a positive catalyst for the ringgit. Next, please. And of course, the FDIs. I think our economy cannot move without FDIs. No point. There's been reinvestments by our local companies when we need fresh money. All right, especially from the foreign side. And this is what we are seeing, from the foreign direct investments. All right, I think over the last few months, we have seen, a lot of announcements, from the US, the European, and also the Chinese companies cementing their interest in Malaysia by investing more into the country. I think so far, roughly speaking, they have already been about 80 billion or more ringgit coming into the country via FDIs. These are the well-documented ones. I think with the rest, I think could easily hit RM 100 billion easily, So of course, with this, we're also looking at the domestic noises, especially from within the construction sector, okay, whereby more projects, especially from the private sector, is being rolled out. I think on a daily basis, if not mistaken, you can see that, I think there's been award, winning contracts, projects, for high rise, for whatever, coming out for the contractors. And this is excluding the mega ones from the government, which is supposedly to be announced soon. If not by this year, it'll be next year. All right. And of course, corporate collaborations. All this may not be one of the prominent catalysts, but we see this as a very positive move by our local companies to do a collaboration, especially recently amongst the telco players, which is going to be positive for the sector to alleviate any wasteful, duplications, right? Next, please. And of course, having said that, is Bursa's liquidity improving? Yes, but to us, it's not enough, right? You can see that, year to date, the average volume traded is around what 4.6 billion shares, as compared to around the 10-year average of about 3.8 billion. That's improvement, but it's not enough. I think I think this is also due to the lack of retail participation, like I've shown just now, which has dwindled to about what 18% now, right? So we need this retail participation to improve, and the daily volume, I think, easily surpass the 7-8 billion shares per day on a daily basis, before we can pump our chest and say that we are on a mini bull run, right? Of course, things are not that easy. Okay, what we can hope now is that consistently we see the inflow of funds from the foreign side and also the local institutions. With this, right, the liquidity will build up, and naturally, this should bodes well for the velocity within the local boss. Hence may translate into higher volume traded on a daily basis. All right. So we need to see the continuous and persistent inflow of funds both from the local institutions and the foreign side. All right. To entice the participation from a retail side. Next, please. Okay, in conclusion, I think looking from our checklist, right, the prominent catalysts, certainly, we are back to the Premier League. I think happy to say, definitely kick-started by the repatriation of funds by the Greeks. I think here also I did a rough estimation. That for every 10% clawback based on their total AUM, we may see about 20 to 30 billion ringgit back into the local boss. Of course, this money won't be invested immediately. Nonetheless, the liquidity is there, all right, for future investments. Okay. All said, I think we expect the KLCI to test the 1780 level by end 2024, based on a 16.8%, 16.8 times PE. This is our 5-year average PE, premise about 16% earnings growth for this year. So for those, for me, the capo ones, right, I just did a simple one, pushing 15.5 times PE on next year's earnings growth, the index should surpass the 1800 threshold. Watch this space. I mean, I'm not surprised at all if the index does breach the 1800 level next year. Okay, as for the ringgit, we believe the local currency is, as I mentioned now, is undergoing some normalization, all right? And we expect it to strengthen to between 410, 420 level by end 2024. Okay, this especially on the back of easing rates in the US. And as you know that, during the height of Federal Reserve hiking the interest rate, right, the spread between our 10-year MGS and also the 10-year Treasury yield, all right, has converged. Sometimes even the 10-year Treasury bill is higher than the 10-year MGS. That is the reason why our ringgit has been so weak, and it's not moving anywhere. But now with the expectations of lower yields from in the US, with the spread widening, right? This is the reason why we are seeing the ringgit strengthening. And if, like I mentioned now, if the Feds were to cut the rates even higher, and the spread differential between the 10-year MGS, ours, and the 10-year Treasury yield, US, to the average of 80 basis point, right? I think our ringgit should certainly strengthen to around the 4 ringgit or even below. So I mean, at the last check, right? I think the spread currently is about 20 basis point. All right. I think on the average, I've done a simple calculation, right? Since year 2000, the spread between MGS, the 10-year yield bond is between 80 to 100 basis point. So certainly this is good news for the ringgit especially. But at this point in time, I'm putting a 410, 420. Let's not get too carried away with the ringgit strength. I think 410, 420, is already good enough performance for the ringgit this year. Next, please. Okay, since we're on the football team, so I think just for our viewers' sake, right? I think how to build up a portfolio. All right. So this is what our preferred 4-3-3 portfolio formation based on football. I mean, those who doesn't follow football, I've already highlighted some explanation on the right. You can see the defense mainly made up of the banks. This is the bastion of the portfolio. Certainly, with their high yield and certainty in growth, right? This would be the base of your portfolio. Though this is, nothing sexy, but certainly, I think when it comes the volatility, right? This will certainly be the bastion of capital preservation for your portfolio. Okay. Then comes the midfielders, the middle portion. Okay. Here we are using, those companies that will benefit from the positive, activities within the sector. Meaning to say, we are using a top-down approach, okay, by employing those sectors that are in vogue at the moment, especially construction. That's why we are putting Gamuda and IGM, and also Suncon there, as a reserve player as well, right? And like I mentioned now, the collaboration between the telcos are also positive for the sector as well. So that's why we are including Sacom DG as one of our midfielders. As for the forwards, these are usually the goal scorers, for those who doesn't follow football. Okay. Here, the forwards or the alpha seekers means, those with the expected high capital appreciation. These are the companies that we like, currently trading at very decent valuations, with the prospect of high capital appreciation. So we have a couple here, like OCK, UP, and also Trust Builder, okay, underpinned by solid growth. I think the four that I've listed outside the field, these are the reserve players, like Suncon, Bursa, Callington, and also Tenaga Nasional. I think Bursa, if what I said takes place, that market would improve over time, and also the velocity of the market improves. I think this should also translate into better bottom line for Bursa. So well, this is for you to appreciate this. This is the how to form the portfolio as per what we perceive at the moment, right? I think that's and next. Is there any more? Okay. Then after that, I'll pass the floor to Pak Ling. Let him take you through the sectors and also the stock picks for Malaysia. Thank you all for your attention.
Hi, thank you, Gary. Let's talk about sector. Okay, next. We'll begin with auto. The earnings remains decent. I think that's supported by a strong booking backlog of 170,000 units. And I think, but due to the limited upside of the companies, we are neutral on the sector. Our top pick is MBM Resources, which is a backlog of 100,000 units of dual vehicles. Banks, as for banks, we are always overweight, which is, as Kenny said, they are the best defensive stocks to buy with a strong dividend yield, 5.5 to 6%, very consistent, and net interest margin of 2.2% until to 2.5%. Going forward, I think we should see more growth with a more predictable interest rate landscape. We like Maybank, CMB, and Alliance Bank for the solid dividend yields. Hong Leong Bank and Public Bank for potential upsides. We like RHB Bank for both strong potential upsides and the dividend yield. Construction sector, we are also overweight. The sector posted a 20% increase in completion value in first half 2024, and driven by strong growth in the civil engineering and also residential. I think the industry has seen a significant increase in the private jobs. I think also the data center and the Mutiara 10 billion Mutiara line. Outlook remains positive. The rollout of public infrastructure like 45 billion Amatric 3, Pan Borneo Sarawak Phase 2, Pan Borneo Sabah Phase 1B, Penang Transport Master Plan. Our top picks are Pinastra, Gamuda, IGM Corp, Sunway Construction, Kerja Prospect, WCT, and Kim Lun. I think this is one of our favorite sector besides bank. Next. Okay, consumer. I think sales are healthy, but the volatility in the raw material and also the manufacturing cost is actually an obstacle for the sector. But on a positive note, the strengthening of ringgit, particularly for the importers, is actually is positive for them. If ringgit continues to strengthen, we may upgrade the sector to overweight. Okay, healthcare and and glove. Okay, we have written. I think we did this long before, not long, just before the latest news came out, whereby the US has put tariffs on Chinese gloves. which will rise 50% by 2025 and 100% in 2026. We have done an sensitivity analysis on the ASP of these glove companies. Currently, the ASP for glove companies is around between $20 to $22 per 1,000 pieces. Assuming a $1 increase in the ASP, the net profit will increase by 15 to 20%, provided that there is no changes in the cost. All right. Okay, no changes in the cost. Based on our estimate, if the ASP returns to pre-pandemic level at around $25 per 1,000 pieces, net profit should increase by 75 to 100%. It could double up. Hence, despite the rally today, there are still potential upsides on glove companies. But one thing we have to note that the ringgit is also strengthening against the US dollar, which is an obstacle. Assuming if the ringgit appreciate to ringgit per US dollar, the upside will be around 10 to 15%, okay, per 1,000 pieces, instead of 15 to 20%. Hence, I think the net effect will be 50 to 75% upside if the ASP returns to pre-pandemic level. However, I think given the situation of, because Malaysia is still the biggest glove exporter, and the US has put high tariffs on China, Malaysia has more bargaining power. Therefore, I think KIV on the ASP, which will highly affect, highly impact the net profit of glove companies. But this will happen in 2025 and 2026. But I think share will run faster than the fundamentals. But having said that, we cannot compare this scenario with the scenario during the COVID era, because there's no spike and a rush of demand on glove. And on the other hand, China may build the factories and also sell the glove to other countries at much lower price to gain back the market share. And there, Malaysia may lose the market share. So we should put some discount to the 50 to 75% upside. Therefore, I think we still have some upside, but just hope that we have better bargaining power, and then we should see what would be the ASP then, because it is still too early to determine how much is the ASP for the glove companies. All right, on the oil and gas, we are facing some headwinds as the Brent crude price declined to below $80 per barrel due to a global slowdown. We are worried that potential cut in the Petronas 60 billion capex. On the first half, Petronas has just spent 25.7 billion ringgit of the 60 billion ringgit capex. But there's one good thing is 18% increase year on year in the domestic allocation, which is positive for Malaysian companies. But overall, because of there isn't much upside on the share price, we are neutral on the oil and gas sector. Next. The plantation, okay, it's very straightforward. The CPO price is consolidating below 4,000 ringgit per metric ton. and earnings are not very strong. There are also absence of upside analysts, upside catalysts. Planters, but bless the planters with a good dividend policy. Ta'an, okay, we quite like Ta'an for the quite the dividend. On the property sector, we are neutral. I think that there's still some challenges in the sector, but we have seen improvement in the residential property sales, particularly under the 500,000. Industrial segment also seen some growth due to the e-commerce and also demand for logistics and warehouse, and also the FDI on building data centers. Most of the companies has run faster than the fundamentals. Therefore, we are neutral. But having said that, we have two favorite companies. One is which is a UP, which is trading at 4 times PE. I think the company is undervalued. This is one of our top pick. And Marsing, I think the company is a very due to it's a very agile in their business strategy, and because they despite being a property developer, they are also venturing into data center business. The power and utilities sector, we are overweight. Main beneficiaries, I think, they are the data centers, which drive the demand, the electricity growth, and the government's target to hit 70% renewable energy capacity by 2050, which is positive for the outlook. And we like the sector for its the earnings defensiveness. The Naga, I think we like the Naga, which has on the back of strong data center rollout and also other topics such as YTL Power, Samadhan, and Solar West. I think the two things are the key factors, which are the data centers and also renewable energy. Okay, that's why we are positive on the power and utilities. Next. Okay, REIT. We are over on the REIT. I think we see some improvement in the footfalls of especially the retail REIT, and also the stable over OPR, which stays at 3%, and also the industrial sectors is also performing well, which I think has been increased. They grew by about 5.3% in Malaysia's IPI in July. The dividend growth for REIT is between around 6%, some with 7%. We like Sunway REIT and Pavilion REIT. The sector, I think it's also poised to growth with the World Semiconductor Trade Statistics. It's projecting a 16% increase in the semiconductor sales for this year, and a robust demand for memory and logic ICs, and expansion of AI and also 5G. The US and China tech war hits up. We foresee, I think, a shift in the supply chain, which will benefit Malaysia because we are staying in a neutral country. We like in our PIE, Netgate, and KGB. We also like LGMS for its cyber security business. On the telco, we are overweight, and due to, I think, as the announcement of the 5G dual network policy has cleared the uncertainty, and the rising demand for the data center also uh, increase the revenue for the bandwidth and the bandwidth, which will drive, I think, which will improve the revenue for the telco provider. I think our topics is a Celcom DG, Time.com, and TM for the potential upside, or Maxis for the dividend yield. We are also like OCK for the supporting role in the implementation of a 5G expansion. Next, okay, we look at a stock pick. Okay, we begin with Binastra. Okay, Binastra is a construction company. The company is currently doing a project worth about 1 billion ringgit, and also the current order book of 2.1 billion ringgit provides strong earnings visibility for 3 to 4 years. We expect strong earnings for FY 25 and 26, because the year end is January, 84.9 million and 103 million. We have a target price of 171 based on 18 times PE. Okay, Grass Builder. Okay, this is also another construction companies which has over 25 years of experience. The company has a solid order book of 1.75 billion, which is also very strong, and which this has a order book cover ratio of 3.5 times. And in the property segment, they're doing quite well, with a 70% sales rate in the Bukit Tinggi project, and the revival of the Latitude 8 project, which is on track for completion in 27. With multiple projects and strong sales, we expect the company to make 10.2 million in 2024. Despite the weaker first half earnings, second half earnings will be higher due to higher recognition. All right, and we expect 12.1 million of net profit for 2025. Our target price is 97 cents based on 13 times PE over FY25. Next, okay, UP Corporation Berhad. Okay, this is a construction company which I mentioned just now, which is one of our favorite, because the company is having quite a lot of projects, has a GDV of 3.1 billion, build sales of over 700 million, and they have also new projects for further, I think, in the near future, with estimated GDV of 1.2 billion. At current valuation, I think one ringgit and 2 cents, the PE is just around 4 times based on the first quarter, annualized first quarter. So we even with the 8 times PE valuation, or the target price is 2 ringgit, which is almost double the current price. This company offers a lot of potential upside. It is one of our favorite companies. Next. Okay, Kerja Prospect. I think this company, I think, has been our company favorite for quite some time, because due to their ability to achieve their profit. I think the profit target, I think they are also able to secure about a lot of projects. I think two key things that are very important, that they deliver earnings with strong margins. They also launched the property development, which will contribute positively to the result. We expect 176 million for FY24 and 190 million for FY25. Our target price is 225 based on a 15 times PE. Next. Okay, OCK Group. Okay, we like OCK Group for its supporting role in the implementation of the 5G, because they build the telco towers and also the expansion in the regional expansion. Despite also the first half profit was not good as expected, but second half, I think this is due to the timing of recognition. In second half, they should do better, and we believe they will be able to achieve our profit forecast of 58 million in 24 and 61 in 25. Our target price is 87 cents based on 16 times PE. Okay, all right. Next.
Hi, good evening, everyone. I'm Chayu, and I will share our US stock pick for today. First and foremost, we have Amazon. Amazon is a multinational technology company that provides online retail shopping and cloud services. It operates through three segments, which are North America, International, and Amazon Web Services. Based on the Bloomberg consensus, there are 75 icons with the target price of $218.78, which provide 18% upside. From the technical point of view, Amazon may trend higher after breaking out from a pennant pattern with an upside gap few sessions ago. Okay, next. Secondly, we have Cisco. Cisco specializes in providing networking hardware, software, and services with a focus on networking, cybersecurity, collaboration, and data center solution. The company is broadening its cloud and security offering while strengthening its software and subscription models to fuel growth and address the increasing need for secure as well as scalable technologies. There are 10 buy calls based on Bloomberg consensus with a target price of $55.05 that suggests 8% upside. On technical wise, long-term uptrend for Cisco remain intact, and it will break out from a bullish flat pattern while trading above the 20-day EMA. Okay, next. Okay. Thirdly, we have Microsoft. Microsoft is well positioned to capitalize on public cloud and AI adoptions, backed by its vast distribution network and large customer base. Enhanced cloud margins are anticipated to drive the earning per share growth as cloud adoption continues to accelerate, emerge as the key leaders. Additionally, operational efficiencies are contributing to stronger than expected economies of scale and margin improvement. According to the Bloomberg, there are 66 buy calls with target price of $499.32, which provides 16% upside. From the technical point of view, the stock is currently broke out from its bullish flat pattern. We believe it will have potential. We will have more potential upside. Next, the fourth one is NVIDIA. NVIDIA's core business is developing advanced GPUs for gaming, AI, and high-performance computing in areas like robotic and autonomous vehicles. Looking ahead, NVIDIA is focused on expanding AI, data center solution, and autonomous driving technology, while leveraging its intellectual property through licensing. There are also 65 buy calls based on the Bloomberg consensus with a target price of $149.04. that suggests 28% of upside. Technical-wise, the stock pending to break out from its consolidation stage. We will see more potential upside if it can break above the 117 US dollar level. Okay, next. Lastly, we have United Airlines, UAL. UAL is currently serving North America and global transportation services with 8 US hubs and membership in the Star Alliance. It primarily earns from domestic routes. The United Next strategy focuses on increasing seat capacity, reducing carbon emissions, and upgrading in-flight amenity and fleet for better efficiency. According to Bloomberg consensus, there are 20 buy calls with target price of $68.45, which provide 33% upside. From the technical point of view, the stock has rebounded from its 3-month downward channel with consecutive white candles. So the outlook remains positive as a bullish crossover is expected. So that's all for the US hot pick. I will pass the floor to Crystal to explain on the Hong Kong stock. Thank you.
Hi, thank you, Chayu, and good evening to everyone. So I'm Crystal, and I'll be sharing on the Hong Kong stock pick. So firstly, we have Alibaba. So Alibaba operates as a tech company specializing in e-commerce, Alibaba Cloud, digital payments, and logistics. Its core business revolves around online retail platforms, including Taobao and Tmall. So based on Bloomberg consensus, we see there's 39 buy calls with a target price of 104.51 Hong Kong dollar. As for technical wise, we see the stock is trending in an upward channel pattern. So in view of a positive cross in late July and trade above all the EMAs, we see long-term uptrend remains intact. Next, we have BYD. So BYD manufactures automotive products. The company produces ordinary passenger cars, commercial vehicles, and other products. So BYD also operates battery making, rail transportation construction, and also other businesses. So according to Bloomberg, the target price is at 306.48 Hong Kong dollar with a 37 buy calls, which is 25% of upside. As for technical, we see the stock is also pending to break out from an ascending triangle pattern. A bullish crossover is also formed not long ago, so this indicates that a potential upside is in the near term. Moving on, we have Geely. So Geely primarily focuses on the manufacturing and also sale of passenger vehicles, including EV and also hybrid. So they engage in automotive research, development, and tech innovation. So as based on the Bloomberg consensus, we see 39 buy calls with a target price of 13.24 Hong Kong dollar. In technical wise, we see the stock is showing promising sign of continued strength, and we foresee greater potential upside if it can break above 9.22 level. Next, we have LinkGrid. So LinkGrid operates as a real estate investment trust. So it manages a diversified portfolio which includes shopping centers, parking space, and also retail spaces. So according to Bloomberg, we see 16 buy calls with a target price of 43.34 HKD. So in technical wise, we see the long-term uptrend remain intact. The stock is currently trading in an upward channel. If there's a further breakdown, we may see a correction mode. Lastly, we have stock pick on Xiaomi. Xiaomi manufactures communication equipment and parts. The company produces and sells mobile phones, smartphones, software, and also set-top boxes related accessories. Based on Bloomberg consensus, we see 35 buy calls with a target price of 22.53 Hong Kong dollar. Technical wise, the stock is trading above its previous resistance at 18.48 level. An upside gap is traded at the end of August, and a bullish movement can be expected in the near term. So that's all from me, and also that's all for our presentation. Thank you all for listening. Now we can move on to our Q&A session. I'll pass the floor to Kenny and Park Ling to take over the floor. Yeah. Thank you.
Thank you, Crystal. Okay, let's move to a Q&A. Okay. Jordan Ng, will monkeypox lead to a spike to glove stocks? I think based on my experience, I think it poses very little impact to as we compare to COVID, because what happened in COVID is that it triggers a lot of what we call closure uh, uh, of, uh, of cities. I think quarantine and like MCO, but monkeypox doesn't cause such this to happen. That's why I think it may not have a very significant impact to the glove stocks.
Okay, there's question from One Rose D. Okay, regarding the prospective higher sugar costs and the impact on BJ Food and Farm Fresh. Definitely, the impact would be negative for both. I think the impact would be more on the BJ Food. I think for Farm Fresh, because they are basically milk based, I think impact would be less significant. And also, most of their products, I would say, priced at a premium. So their segment of buyers possibly can absorb a slight price increase if they want to do so. All right, by Farm Fresh. All right. There's another question from Yanni. Okay, regarding the ringgit appreciation, changes to the Malaysian market. I think, broadly speaking, I think this is positive. I think for those foreign funds that intends to invest in Malaysia, right? I think they can easily make money from both ways, like appreciation on the ringgit first, and also the equity market. So it is a win-win situation. Who wouldn't like that, right?
So that will this also will reduce inflation and also cost of production. Company producers for local manufacturers catered for the local market will also benefit from the appreciation of ringgit. Yeah, I think other sectors such as retail will also benefit, because the cost of doing business will definitely be cheaper with the lower importing costs.
Okay, there's a question from there's a question from Stephen Fu on why technology sector, I think not very bearish. I think just a temporary downtrend. I think it's basically due to the high valuation that most of the technology companies are trending at the moment. I think, and also due to the recent maybe the sell down in Nvidia. I think this has also caused some spillover effect onto the local tech companies. That's why we are seeing, tech companies at the moment not going anywhere. But I think once the sentiment returns, I think these tech companies with the high delta, right? I think high delta means, once the market move upwards, these companies will certainly move faster than the index. So faster than seatbelt, just wait and see. Okay.
Okay, I think previously there was also run up in the tech stocks. I think this is also partly profit-taking activities?
Okay, there's another one from same Stephen Fu as well. Okay, that the KLCI index has been trending up, but only the finance sector, while the others are sideways. Again, not bearish, just that hasn't made a move yet. All right. Okay. Why the finance sector? I think basically when the foreign funds comes into the local market, right? The first thing they look at are the big caps. I think naturally the banks would be the automatic target first. That's why we are seeing the banks to have performed so well of late. And then cascade down, we may even see the telcos, the big caps like amongst the within the KLCI. I think the top 10 cannot run away. Those are the targets for the foreign funds. Then once these companies has reached maybe their full valuation, maybe these funds will look somewhere lower within the KLCI constituents like the manufacturing or the plantation stocks. Small cap bearish. I think small cap not bearish again. Still not going anywhere. Like I mentioned now during my presentation, it is suffering from the lack of liquidity due to the influx of IPOs. I think a lot of money from the retailers has, I think, it's being stuck, within the IPO space. So what we are hopeful to see is that once the liquidity build up from the influx of foreign funds and local institutions, right? Hopefully, this will instigate or entice more participation from the retail segment, right? There's a question from, I'm not going to say from who, your father, something. Which sector would benefit more in the US election if Kamala Trump would win? I think your guess is as good as mine. I think certainly, personally, I would prefer to see Kamala Harris to win. I think she's a more steady person rather than now I name him Mafia Trump. I think with Trump, I mean, we have experienced, what happened to the stock market when he was the president, a few years back. I think he came out on a daily basis tweeting nonsense, making, I think, heighten all the market volatility. So, personally, I would prefer to see Kamala to win.
Yeah, a nonsense tweet can cause the market to just fly, just up or down, but mostly negative. So I think Kamala is a better choice.
Okay, one question regarding how many times you feel that the Federal Reserve will lower the rate and the impact on KLSE. I think the more the better, I mean, if you mention about the impact on the local market, because at the moment, expectation is that the Federal Reserve will reduce the rate consistently during their meeting, meaning to say September, November, and December, right? So for me, if this happens, this will certainly bode well for the domestic stock market. I would, for this year, I don't think Bank Negara would do anything to the interest rate. But if the Federal Reserve is being aggressive, okay, and reduce the rate by, let's say, 100 basis point collectively, we may even see Bank Negara tweaking our OPR lower by at least 25 basis point, right? This should be positive to to the local market, and also with the lower interest rate, meaning to say lower fixed deposit rate, maybe this will also entice more retailers to withdraw their money and invest into the stock market. Fingers crossed. Okay, any more questions or not? No more questions.
Okay, I think it's 9:15 now. I think that this should be the end of our webinar. Let's come back, Chayu and Crystal.
Yeah.
Hi, ladies and gentlemen. I think thank you for joining us. We appreciate that, and we hope we will see you again in the next quarter.
Yeah. Happy Mid-Autumn Festival, is it?
Yeah. Happy Mid.
And enjoy your
And go and have a look at the moon. Snap a picture of the moon.
So, thanks again for joining us today. Good night.
Have a pleasant week ahead.
Yeah.
Good night. Bye.
Bye bye.